The Aquest Podcast, Funds Industry Conversations.
Hello, podcast listeners, and welcome to this episode of the Aquest Podcast with me, Danny Lawler. In this episode, we're in problem-solving mode. Well, at least problem identification mode. In 2015, a new regime was introduced in Europe for investment funds called the ELTIF, or European Long-Term Investment Fund. And the idea was that it would be available to retail investors and give them the opportunity to get exposure to long-term assets like infrastructure projects and also to things like SMEs. It was a good idea, but to be fair, it hasn't really worked. At this stage, there's only around 60 ELTIFs established in Europe and none of those in Ireland. So for this episode of the Aquest Podcast, I'm joined by Ken Owens of PwC, where we chat through the background to ELTIF, the problem it was designed to solve, how it's evolved, and how it's not really managed to achieve what it set out to. There was a Commission proposal to make amendments to ELTIF that published towards the end of last year, and so we chat through that proposal and whether the changes that the Commission is suggesting will actually have the desired impact of getting some traction for the ELTIF regime. On top of that, we look at some other possible solutions to try and make the product better and more attractive to the retail investors in particular. So with that, let's get on with the show.
The Aquest Podcast, Funds Industry Conversations.
Good morning, Ken, and welcome to the Aquest Podcast.
Good morning. Good to talk to you.
Yeah, it's great to have you on the show. I got my circular email yesterday from Irish Funds to say that the conference was going ahead again this year, in person, live in the convention centre. So I guess things are getting back to something like normal.
Yeah, they are. Yeah, I'm in our office today, and there's a bit of a buzz around the place. So people have started to kind of come back now. So, it's good to be back in the office and seeing people out and about. And
I see you in a shirt and tie.
Kind of normality. Yes, I put my tie on especially for you today.
You're very good. I couldn't tell you where I might put my hands in the tie now. I had my first kind of coffee out in so long the other day, and trying to leave the house, I was trying to remember where my leather shoes were. It still had any. I nearly left it by Crocs, so it's getting back in the swing of things.
Yeah, there's some things we've kind of gotten used to now that it's hard to kind of go back to the old days in some respects. So hopefully, we won't all go back to everything as it was before. We'll take the best of what we've learned over the last 2 years in terms of how to operate and how things get done, and how we can work remotely and just build on that. I think that's hopefully certainly my hope anyway, and what I'd like to do. So
how long do you think it will be before the good things get forgotten and we slip back into the old habits?
Yeah, well, I'm hoping that we don't slip back to old ways, but it's amazing how quickly we adapt to things. I suppose we're creatures that, we are very adaptable. So the market will find its equilibrium as it always does in everything else. If individual firms or whatever go too far, then their people will tell them that they've gone too far.
Well,
anyway,
people will
that could be another podcast.
It will, and I'm bringing optimism with you, Ken. We're going to chat ELTIFs.
Yeah, it's kind of a funny kind of a beast, because to be honest now, it's not something. So I spend most of my time now talking to clients about regulatory stuff from an Ireland perspective, and certainly in the last 12 to 18 months, private markets and private assets, and has been from a few different angles, has been the topic that's got a lot of attention. So we're clearly hearing and seeing a lot of our clients moving more into private markets.
Have any of them ever asked you about ELTIF? Has it ever?
No, never. And it's funny. I've been obviously been watching the F&D review closely, and we were heavily involved in. As a firm, we'd lots of groups involved, mobilized to look at the response, to talk to clients. Nobody, and obviously the review came out at the end of last year, and there was a bit of activity around that. To be honest, nobody mentioned, because the ELTIF review came out at the same time, and the proposed changes to the ELTIFs, and I've updated my regulatory update decks to tell clients what's happening. Certainly from an Ireland perspective, nobody asks me to talk about ELTIFs. Clearly, we don't have any ELTIFs in this market at the moment, and that may be a factor.
Poor old ELTIFs.
Poor old ELTIFs. They're kind of, like they suffer from having, they're kind of a hybrid. So I was kind of trying to come up with an analogy as to what kind of analogy would I use, and I just couldn't find one that. But fundamentally, I think the problem, there's kind of two problems with them. The first problem is it's kind of, they don't know what they want to be. So you've, on the one hand, you've got a very dominant UCITS product that's well known, has all the bells and whistles from an investor protection perspective. It's designed for retail investors, and clearly lots of managers pushing that product. And then you've got the EAF under AFMD, which is is an institutional product. It's professional investors. It's got all the flexibility, and then you've got something that's trying to compete with kind of both in the middle. It's trying to attract retail investors that might be attracted to UCITS, but it's then trying to invest in make investments and compete from a strategy perspective with ELTIFs, and the ELTIFs are ELTIFs anyway.
Sorry, I better briefly explain what an ELTIF is for our listeners, just so as not to assume knowledge. It stands for European Long-Term Investment Funds. It is, as you said, Ken, it's an ELTIF, it's an alternative investment fund, but it is a bit of a hybrid. So it's designed to be sold to both retail investors and professionals. And the idea being that it would invest in longer term assets like infrastructure assets. And it came out of a study or an understanding that in Europe, we tend to have a lot of bank financing for projects, where in the US, you tend to have a lot more capital market financing. And when the financial crisis hit and the banks stopped lending, it had a knock-on effect then on the ability of projects to get capital. So as a means to kind of ensure that didn't happen again, or help for that not to happen again, the Commission want to promote alternative sources of financing. And one of those then is the idea being that capital markets would be more active and larger in Europe, so that they would be a ready source of capital for things like infrastructure projects, rather than being dependent on bank financing. So very laudable, I guess. But as you mentioned, Ken, we've had ELTIF around for about, up in 10 years nearly now. And so far there are only 57, 60 odd in Europe, and none of those in Ireland. So can't be classed as success from that perspective.
No. And I think the latest data I've seen is there's 67. And AUM is 2.5, maybe 3 billion, something like that. So it's, in the context of a market that's got about 30,000 funds and is 13, I don't know I should know what the European market is now, but it's like in the trillions. ELTIFs are, as a product, I think have not really captured the imagination. There's a couple of markets where they are being sold. So, in looking at it, the products that are out there, France and Italy seem to be the two biggest markets that have kind of started to adopt them. But more broadly, I think the EAF and AFMD, the EAF, that the regular EAF product is just far more usable from a manager perspective. So you've got the problem firstly about it has to be a closed-ended product as an ELTIF. So lots of investors are happy enough to invest in closed-ended products. I think even institutional investors, I think from a retail perspective, that can be problematic. And then I think the other issue is leverage. These kind of, particularly what we're hearing and seeing from managers around a lot of these products are in the real asset space, is there is leverage required. People need to be able to leverage the products, and certainly in the original ELTIF there was only, I think, a 30% limit for leverage, and that was problematic when you're competing with AIF products that had no, certainly didn't have the same restrictions around leverage. So if you're an
Yeah.
institutional investor and you want to kind of invest in a hospital or in a toll road, or you want to invest in SMEs, into private equity investments, part of your calculation around your return is how much leverage do I need or can I use to lever the structure and to make the return more attractive.
Yeah.
And if there's limits on that, then even if you didn't plan to use you plan to use leverage, like all else being equal, you want to have the flexibility that if you need something, you can use it. So if something is more restrictive than you'd like it to be, I think generally, and what we see from clients is they go, okay, I'm not going to go with that route because it might, maybe they don't plan to have, excessive, a lot of leverage in a structure, but they want to have the option.
Yeah.
And if you're in the ELTIF and you have a hard limit, then that optionality goes away.
Yeah, and it's felt even since the outset of ELTIF that the Commission had identified that, for example, retail investors holding a lot of cash or in deposit accounts or whatever were potential for a big source of capital for financial markets, for capital markets, but needed to be encouraged or cajoled or incentivized to take that and put that cash, take it out of the mattress and put it to work.
Yeah.
ELTIF was to be the product that would do that because it would be regulated. I guess the idea was it would have a brand like UCITS and now like AIFMD that you could trust in, and you say, well, I kind of know what that is. I'm going to put my money to work, and it's going to fund infrastructure or hospitals, whatever it is. And although it's tied up for a period of time because they're closed-ended, it's still worth the investment. And the benefit then from a provider point of view being, well, ideally this brand would build up so that you hardly have to open your mouth and just say the word ELTIF and people would jump on you for the product, but also that you would get a European passport for a product, an EIF product, because the moment the AIFMD is obviously, it's a manager directive, it gives passports for EIFs, but only to professional investors, and this would give you a passport to retail investors. But as you said, Ken, with all the restrictions that were there originally, at least, you felt like, well, why would I set up and subject myself to the ELTIF regime when I can get my passport under AIFMD? They're the types of products being closed-ended that retail investors aren't necessarily that suited for, probably, or in some instances. So actually, I can get all I need out of a qualifying investor EIF or something similar in other jurisdictions, and that's where I'm going to go.
Yes, so you've raised a good point there, and it's something we're looking at a bit at the moment because there's a consultation now. But I think from a manager perspective, there's a problem around retail from a suitability perspective. So at the point of sale, like I think an ELTIF is a product that needs advice. Because it can't be, one of the restrictions was it can't be more than 10% of the portfolio of the investor. Clearly, you don't want to have all your eggs in one basket, and because of this product, we're basically saying, well, it's fine as part of a portfolio, but they don't want a retail investor putting all of their savings into one product. So it needs to be part of an advised portfolio. So then you rock into suitability requirements, and managers and distributors having to do a suitability assessment of the client, their risk appetite, their ability to understand what they're investing in, and their ability to sustain the investment. And I think there's a lot of risk and a lot of liability attaching to that from a manager perspective. So I think even if you got over that hurdle of, getting the investor to kind of want to invest, because there's a bigger, obviously, issue. There's a bigger issue generally. It's not that retail investors aren't investing in ELTIFs. Retail investors in Europe aren't necessarily investing to the level required, full stop. And there's a broader discussion going on and broader consultations and reviews going on at European level as to how you activate retail investors more on an overall basis, and ELTIFs would be a subset of that. But you do run into the issue then of, well, these have to be advised products. Investors would have to go through suitability. They'd have to, you have to explain what they, obviously what the product does, and the liquidity constraints, particularly around, getting your money back out again. And I say a lot of retail investors are just going, well, if I'm presented with a range of options for products, and this product is at the riskier end in terms of what it will invest in, and it has liquidity constraints where I can't get my money out, versus a much larger portion of UCITS products, for instance, that don't have those issues, particularly over, in a market that's been increasing for the last 8 years or 10 years. So you're going from a performance perspective. I can see all this performance out there. I think that was always going to be a battle.
Yeah.
I mean, the interesting question is whether with the whole focus on ESG now, as to whether there's a niche or an opportunity for the ELTIF to carve itself out in that space. So when investors now have to be asked about their sustainability preferences, whether the ELTIF, or ELTIFs could become something that comes more to the fore because of what they might be able to do from an ESG perspective.
Yeah, I think that's a good point. But just to go back a moment, you're right. When you have any amount of opportunities to invest as a retail investor, whether the ELTIF type product is the right one for you, in terms of the restrictions and the lockup period that your cash is into it, is one thing. But also as an advisor, or somebody who's giving investment advice or recommendations, it's an advised service to that retail client. You may not feel comfortable directing your retail clients to a product like that. So it may well be that of all the retail investors out there, if you could get them to invest, it would be a fairly small subset of retail investors for who a product would be suitable. So moving on then, in terms of trying to improve the ELTIF product, we had proposals towards last year that, in fairness, have given it a good old, or are proposing at least a good old shake-up to the rules in ELTIF. Do you have any views on what is proposed? First, in terms of the proposals themselves, but then on the bigger question of whether it'll shake the ELTIF structure and we see more traction and go from 0 ELTIFs in Ireland to maybe some.
Well, first, I think we do need an ELTIF regime in Ireland. So I think, we as an industry, and I think there's already engagement with the bank. I certainly saw something recently that tells me that there's a bit of discussion with the bank about actually, there being a bit more focus on that. But in terms of what's proposed, I suppose there's kind of summarizing kind of 3 areas. Firstly, they're trying to, the proposals are to make the actual ELTIF, make it more flexible in terms of what it can invest in, and to remove some of the thresholds and limits, to allow some differentiation also between ELTIFs that are just for professional investors versus ELTIFs that are for retail, and to obviously that might mean that more professional investors can take it up because it has a little bit more flexibility, and kind of brings it more closer to what the professional AIFs can invest in. They're also trying to remove some of the barriers for retail investors. Now, the cynic in me, and I'm paid to be professional skeptic as an auditor, tells me I don't necessarily think the barriers to accessibility were what stopped it from a retail perspective, but at least removing the minimum investment limits, and aligning the suitability requirements with MiFID, at least may make it somewhat more usable. And then probably for me, I think the ability to introduce the liquidity window, so that it would be feasible for investors to kind of exit rather than having to wait till the end of, say, the 10-year period. Now, that's obviously, practically could be a challenge in terms of, well, what is it invested in, and is the liquidity actually there? But at least the possibility of being able to do that is proposed to be introduced. So I think that's all positive. It makes the product more usable. potentially.
I feel a but coming on, Ken.
Well, I still don't think it's like, it doesn't solve the fundamental problem, and I think it's back to your point. Like, if you look at where LTIFs have been successful, relatively speaking, there's always been something else. There's the making. I think the old adage is you can take up the horse to water, but you can't make them drink. So I think I think to kind of give the LTIF the spurt that it needs, there needs to be something else as well, and I think that needs to be, some USP that the LTIF has that would make it put a bit of oomph behind it. And I think we've talked about incentives. So could you in some way, or could governments in some way incentivize investment? Now, in Italy, where LTIFs have been, there have been a few of them created. There was a tax exemption for investors. Now, what you do in that scenario, I think this is where LTIF run into a problem at a pan-European level, is if you wanted to invest in your economy, and you offer tax incentives to your kind of population, then you kind of limit it to your own country, because so if you want investors in Italy to invest in Italian infrastructure, it makes sense as government maybe to offer an incentive to kind of promote that, but clearly you're not going to be offering that incentive to non-Italian investors. It just doesn't work because taxation is not harmonized. So I think taxation as a mechanism could be a way to incentivize investment, but that has the disadvantage of being, obviously it's country specific, and taxation is a national competency. So I think that was one of the issues that was identified in some of the analysis that was done of the LTIF post the initial setup, and looking at how they might improve it. They've been able to address the investment restrictions elements and kind of make it more liberal in terms of what it can invest in. They've been able to loosen some of the restrictions around what the eligibility from an investor perspective, so to make it more usable from a retail investor perspective. But what they haven't been able to address is the incentivization element of how do you want enable investors, or kind of promote the fact that investors might want to invest in the product. And if you're going to use taxation as a mechanism to do that, that doesn't work on a pan-European basis.
Yeah, I think you're right. We've seen with the product, and even with improvements that are suggested by the Commission, unless investors haven't found their way there, and providers haven't provided the product, because there just isn't the momentum behind it, isn't the so incentivization is needed. And if I think of the great incentivization products we've had here, you can't look past the SSIA now. Not that you'd necessarily do that, but you're talking about capital guarantee and guaranteed return, and that is the kind of thing that will encourage a retail investor to take the money out of the mattress and put it in something. If they feel, well, at least I'm not going to lose any money, and I'm going to make this amount, and ally it maybe to taxation incentive. That's powerful. That is the sort of thing that will get people active.
Yeah, I think it could. I mean, you like if you were looking at investing today, if you've got let's say you've got some money to invest, I think one challenge is, if you're leaving it in the bank at the moment, you're losing money, and you've got inflation in the economy. So now is the time, and I'm not giving investment advice here, but certainly as an investor, if you have money, obviously putting that money to work is important if you want to invest for your future. And there's the whole debate about pensions and saving for the future that's out there. So I think aligning this with pensions and the ability, from a pension perspective, to have something that can generate a long-term sustainable return, the LTIF could have a future there. And there's a broader debate about pensions that we all need to have, but you could see that because the types of things that the ELTIF invests in terms of long-term investment are the kind of things that pension funds invest in, and they aren't necessarily as volatile as the equity markets. That's not to say that there isn't risk involved, obviously. I think a broader question, I suppose that's kind of making it more attractive. What is it investing in? The issue, the kind of original genesis of the ELTIF was, we need more non-bank finance in capital markets. And that has happened and is happening. It's not that isn't happening and that the ELTIF was the only mechanism. So that also is a question about, even if there was a flood of money coming into ELTIFs, that money is going to be competing with a lot of other structures and products that are out there also looking to invest in the same kind of assets. So that's also a question about, certainly I was reading something yesterday about the wall of money that's been invested in private equity and in real assets, the amount of money that has been committed by lots of the same institutional investors that maybe might want or might be targets of using the ELTIF. Some of that money, a lot of that money has not been invested because they haven't been able to, find the deals and make the investments. That will have a dampening effect on the return that investors have to accept, if they want to put that money to work. And I think certainly some investors understand that the returns that they were getting in the last few years may not be the same returns going forward. So the question then is, if you're putting that investment in front of a retail investor, how attractive is that to that investor, and what other elements do you need to have attached to it? And I think you've mentioned capital protection would be a fundamental point that you think your average retail investor might look for. So that downside protection, so that they're what are they, if they are prepared to lock their money away for 10 years in the product, and it's investing in infrastructure, that there is at least some comfort that actually it will generate a modest acceptable return, and that the capital will be there when they go looking for it, or when it comes out at the end of it. That there's a lot of elements to kind of get that in place. So I think there's probably a good bit to go yet.
And I wouldn't if you're thinking pan-European wide, you're right. The taxation is very powerful, but if I'm looking to increase investment in Italian infrastructure and I'm the Italian government, well, I might give a tax break to an Italian ELTIF, but only if it's going to invest in Italian infrastructure, and
exactly
those national limits around the products isn't really compatible with a free movement of capital.
And
the capital guarantee route, I wonder whether at a European level there's an institution that could be the support for that.
Because again, you run into it's all very well for the bigger member states to offer that to their investor base, but when you get, if you look at Europe, clearly you've got Ireland and Luxembourg being the kind of two main exporting product hubs, and clearly that wouldn't necessarily work in those domiciles if they were if those products are being being sold in other member states. Again, that's probably problematic as to who's going to give that guarantee, because clearly governments aren't necessarily going to want to do that beyond their own investors. So I think again you are kind of looking at maybe something that could be activated at an EU level.
So incentivization important, but quite tricky to solve. I think issue, you mentioned it earlier, Ken, is I guess in Ireland, well, at European level, to have the ELTIF as a standalone product. In Ireland, if you did want to create an ELTIF, the expectation is that it would be authorized as both an ELTIF and then either a retail investor AIF or more likely a qualifying investor. So you end up then with two sets of rules imposed on the same product. not
Yeah.
not a reason for the product to be attractive.
No.
But that's solid,
No.
I would have thought.
Yeah. Yeah. I mean, I think there does, like I suppose more generally there needs to be more harmonization. So I think if you're going to make this product more usable, then there needs to be, clearly, like it does run into the issue of there being local requirements and kind of, I think the term that Esme uses is regulatory fragmentation, which can be positive or negative, but it's usually negative. So I think you need to kind of minimize the regulatory fragmentation, so you've got one set of rules that everybody can apply. It's obviously easier to explain to investors then as well, the retail investor, this is the rule, it's the same rule everywhere, and why that rule is there. So I think that would be important. I think the other aspect, though, just strikes me, and again, it's something I've seen recently, is there obviously does need to be a bit more of a focus on financial literacy to the retail investor, because fundamentally, if there was a pile of money out there for managers to manage, they would be managers lining up to manage it.
Yeah.
So the question is, is the product something that somebody's trying to sell to an investor, or is it something that actually investors want to buy? And that's that applies across the board. But I think in terms of something like this, like I think investors have to want to buy it, and that comes back to, firstly, the literacy point about, well, actually why investing is important for your future. And obviously, with all the focus today about cost of living, people might be saying, well, we actually don't have the money to invest, where we've cost of living issues to deal with. But fundamentally, saving for your retirement, for your future, is important, and that needs to be built into the education system more than it is at the moment. And as part of that, understanding, what these products can do, and that, I think, would also increase demand, because the appetite then there would be more appetite amongst the retail investor to say, well, actually, I do want to invest in something where I can see the benefit, the impact, both in terms of obviously my own personal wealth or savings pot, but also improving our economy or improving our infrastructure. If you can see, a new hospital being built or a new bridge being built, and you can link back your investment to that obviously would incentivize, not everybody, but some retail investors to go, okay, I can see I'm doing good for my economy and for myself at the same time.
The big issues there, Ken, like that's, you're right, it's an enormous cultural shift, and not that it couldn't be done or won't be done, and but will take a bit of time. So one question to wrap up, Ken.
Okay.
When you think about the problems with ELTIF, need really for good incentivization, ideally the need for more harmonization, so it's a standalone product without additional requirements nationally. When you think of the fact that there is actually other monies making their way into the capital markets and into the private markets, is there a problem there for the ELTIF to solve? And in a word, should we dispense with the ELTIF? Should we kill the ELTIF?
That's a hard question. At the moment, I think it's a very niche product, and I think we have at PwC, we have values, and one of our values is reimagining the possible, and I think the ELTIF is something that needs to be reimagined completely. I think tinkering with around the edges and tweaking it a bit isn't going to turn something that has 60 into 600 in a short space of time. So I think you do now, like, there does need to be a kind of a reimagining of the possible here, and maybe the whole focus on sustainability and ESG is a way of giving it a bit of a shot in the arm. But obviously there are other, again, ELTIFs and useless products out there competing in that space too. So I think at the moment it's probably a hammer trying to find a nail, and I think it needs, I don't think it's going to be the major success that I don't think it's going to compete with UCITS, put it that way.
Yeah.
From a retail, I think there's a niche. There maybe is a niche there, but there's a lot more needed than just tweaking the investment restrictions and the eligibility criteria to make it a success going forward, I think.
But on that shameless plugging of PwC and the reimagining the possible, you're a real pro, Ken. I love the way you.
I had to slip it in there,
Conversation. Thank you very much for
no problem.
Joining us.
Delighted to talk to you. Always good to speak to you, and look forward to chatting again.
Great. Well, I'm not sure we've solved the problems of the ELTIF, but at least we've had a bash, and I do think you're right. I think reimagining is revolution rather than evolution. I feel is probably required here. Thanks again for your time, Ken, and thank you, listener.
All the best.
The Aquest Podcast, Funds Industry Conversations.